In this week's video, we'll examine updated charts of numerous asset classes and ETFs to help us answer the question, does it look more like a pullback or a new bear market? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. With the Fed talking about raising interest rates again, we've seen some volatility. Therefore, it's probably prudent to check in on some of the moving averages that we've used in past videos and see how they look today in numerous ETFs and asset classes. This is our weekly NYSE chart, 1982 to 2016, that we covered a few weeks ago using the generic and for illustrative purposes only 30-week in blue, 40-week in red, and 50-week moving average in green. You may remember that we said this signal has only occurred 10 other times in the past 25 years. The 11th recently occurred in 2016, and in the 10 previous cases, the average number of weeks that the market rallied following the signal was 108 weeks, and the median was 102 weeks. Looking at a few historical examples to jog your memory, a full-bore bullish look is when blue is above green and red, and the slopes of all three are up. In this case, after a period of consolidation, the market rallied for almost 4.5 years while the signal stayed in place. Conversely, we showed that after 21 weeks of sideways movement in 1999, we got a bearish moving average crossover here and a full-bore bearish look, and the stock market basically fell after the signal for an additional 2 years. Then a bullish turn came in the moving averages in 2003, and after that, the stock market rallied for more than 4 years. Were long-term trends helpful in the financial crisis? The answer is yes. You can see blue drops below here, and we get a full-bore bearish look. The stock market dropped for over a year after this long-term signal was registered in this area here early in 2008. So visually, this is the look we want to avoid. Higher risk is when blue is below green and red and the slopes of all of the moving averages are down. Therefore, how do these moving averages look today on the S&P 500? These are the same weekly moving averages, the 30, 40, and 50 as of the close on October 14th. We've taken price out of the equation because it's volatile. This helps us filter out that volatility and focus in on the longer-term trends. This is the look that we want to avoid. The present-day look really doesn't look anything like that as of the close on October 14th. If we compare the present day here to the early stages of the dot-com bear market, again, we really don't have a look that looks similar to this higher risk period here. In a separate analysis a few weeks ago, we used daily charts, and we used the 50 and 200-day moving averages to illustrate basic concepts relative to longer-term and intermediate-term trends. This is a bullish look here with the red 200-day moving average rising and the 50 above the 200. You can see here, this is our full-bore bearish look where the 50 drops below the 200, and most importantly, the slope of the 200-day moving average rolls over in the early stages of the bear market, telling us that the long-term trend has now flipped from bullish to bearish. Therefore, we will go through numerous ETFs and asset classes and ask, how does the long-term trend look? How does the intermediate-term trend look? In each case, we'll look at the 200-day and the 50-day, and we will also look at the for illustrative purposes only weekly moving averages that we just discussed. As a reference point here, things look decent early in 2007, and then we go to a more concerning look late in 2007, early in 2008. Before the big plunges in the financial crisis, our long-term trend is up, indecisive, rolling over early in 2008. Therefore, in the present day, this is the type of look that we want to avoid. And this is the type of loss that we want to avoid. A 50% loss in the S&P 500, more than a 50% loss in the dot-com bust. Similar situation in the financial crisis. Very difficult to recover from that. And the market model was basically built on the premise of, does this look like a pullback or does it look like a new bear market? Longer term trends can help us with that. Volatility to ignore when the slope of the 200-day is up for the most part from 1995 into the year 2000. Volatility to respect. Now the long-term trend is telling us risk is higher. Bear market, during the whole bear market, things looked ugly. Improvement. Bull market, volatility to ignore within the bull market, and then the 200 rolls over. Same thing. When the new bull starts, we get a bullish turn. Therefore, in the present day, one of the first questions we want to ask is, does this look like a pullback within the context of a rising and bullish trend, or does it look like the beginning of a new bear market? Does it look like the beginning of a new bear market? And one of the easiest ways to look at that is the slope of the 200-day, and we will focus on it when we look at the charts as of the close on Friday, October 14th. And several weeks ago, we covered volatility, and there was a reason why we covered volatility when things were relatively quiet, because we know within the context of an uptrend that volatility is part of the equation. The long-term signal here says to stay with the market. If we're using this as our only signal, roughly from 1991 to 1994. How much volatility was in A, B, and C? The answer is quite a bit. Volatility is part of the equation. The fact that we use the term volatility to ignore, that basically says we know going in that volatility is going to be part of the equation. To capture this 6% gain, almost a 7% drawdown in the S&P 500, 6% drawdown. Within the context of longer-term trends, that was volatility to ignore. No picnic to capture the 8% gain from point A to point B here. Numerous drawdowns and a ton of volatility. So when we look at the present-day charts, we're going to try to discern between volatility that looks like a pullback and volatility that looks more like the early stages of a higher risk period, like the early stages of a bear market. This is the physical gold ETF GLD on Friday, October 14th. 200-day moving average. The long-term trend is still favorable on October 14th. Notice here, when the trend is unfavorable, notice how volatile the 50-day is. The long-term trend is down. This is a counter-trend rally, a counter-trend rally, a counter-trend rally. The long-term trend is up. This is a counter-trend move. So far, this looks like a counter-trend move within the context of an ongoing and established bullish trend. Is it possible on all of these charts that this look here morphs into a look like this here? The answer is absolutely, positively yes. But in this case, it hasn't yet, and this slope still is indicative of a strong and rising trend. Obviously, that's subject to change, but we manage based on the facts in hand, not forecasts about an incredibly difficult to predict future. Now let's move to the generic, for illustrative purposes only, weekly moving averages. The 30, the 40, and the 50. This still looks like a longer-term downtrend trying to flip over to a longer-term uptrend as of the close on October 14th. A good system should work across all asset classes. Therefore, the S&P 500, this look here, the one we want to avoid, and this look here, the one we want to avoid, is still helpful in terms of comparing the look of GLD now. This really doesn't look anything like this or this, at least yet. From a retracement perspective, these are the A to B fibs. This move here, so far, we've come down to the first fib, which falls into a normal retracement. Is it possible that GLD falls down to this area here, the 50% retracement? Sure, it's possible. That would also qualify as a normal giveback or retracement within the context of an ongoing and established bullish trend. Nothing abnormal about this yet. Now we can see how the 200-day tends to be more useful from a long-term perspective. This is SPY here, the 200-day in red, the 50-day in blue. You can see that concept of a downtrend, counter-trend rallies in the 50, an uptrend, a lot of volatility in the 50-day while the slope of the 200-day stays up. This is a counter-trend move, counter-trend move, counter-trend move within the context of a rising trend, and eventually it flips over in 2007. Therefore, a quick check of a trend, the slope of the 200 works well. Slope rolls over in 2000, turns back up in 2003, and rolls over again in this example in 2007. The total stock market, a broad measure of the health of the stock market, right now, the slope of the 200-day looks like it's trying to turn back up. It looks more like this than it does this or this. This chart, October 15th, 2:09 p.m. How about our weekly example? VTI weekly in its present form really doesn't look anything like this or this. How about real estate investment trusts? A lot of indecisiveness in here, and then the long-term trend starts to turn back up. If we look at REITs from a weekly perspective, we still have a healthy look here relative to these higher risk looks in 2000 and 2008 on the S&P 500. It's important to note the math works the same way. The math can't tell whether it's looking at a REIT or the S&P 500 or a currency or a physical commodity. A trend is a trend is a trend, and math is math. If good things happen in REITs for a long period of time, the 200-day moving average will have a positive slope. If bad things happen in REITs for a long period of time, eventually the 200-day moving average will have a negative slope. Those statements apply to all asset classes and all trends. You can see a ton of volatility here in interest rate sensitive financials, XLF. This is a reflection of the Fed talking about raising rates and then backing off, then talking about raising rates, then backing off. They've created a tremendous amount of confusion. Even XLF, it's a laggard. 200 days trying to turn up, the 50s above the 200, and even the intermediate term trend looks decent here, at least for now. Similar situation on the weekly, trying to turn back up in a favorable manner as of October 14th. Don't have the high risk look here yet. How about TLT or bonds? The slope of the 200 looks strong, still going in this direction. When price drops below a 200-day moving average that has a positive slope, that's quite a bit different than price dropping below a 200-day that's trying to roll over. This is a higher risk period when price drops below. This is increasing risk, but it's lower risk relative to this here if price were below. Here's your indecisiveness with the Fed going back and forth and the long-term trend from a weekly perspective for TLT, despite the recent pullback, has not rolled over yet. This math here doesn't really look anything like the high-risk math we're trying to avoid. Therefore, if you were to look at this chart and say mathematically, does TLT look like it's experiencing a pullback within the context of an ongoing and rising trend, or does it look like it's flipping over to a new bear market? Right now, using this chart, the answer is relatively easy. It looks like a pullback within the context of a rising trend. If this chart here starts to look like this here, then our analysis of the chart would change, but it hasn't happened yet. There's a ton of volatility in the 50-day moving average here within the context of a long-term and rising trend. Global stocks right now, the 200-day as of October 14th, looks more like this bullish period here in 2003 than this bearish period in 2000 or 2007. Similar situation from a weekly perspective. Looks like it's trying to turn back up. Doesn't really look anything like the bearish turns in 2000 or 2008. Intermediate term bonds, October 14th at 2:16 p.m. The 200-day moving average still has a strong and rising trend look to it. Similar situation when we look at the weeklies. Don't really have much in common here with those high-risk periods that we want to avoid. Equal weight S&P 500, does it look more vulnerable with this 50 here? Absolutely, positively, yes. But you can look more vulnerable within the context of a rising trend. Our concerns would increase if that 200 looked more vulnerable in the present day. Right now, it still looks good. Equal weight S&P 500 weekly also has a bullish turn look on October 14th. This looks quite a bit better than this or this. Silver long-term downtrend 50 is volatile when you have counter-trend moves within the context of a downtrend. Now it's turning back up here. So far, this looks like a counter-trend move within the context of a rising trend. The weekly chart for silver's looked ugly for some time. This is 2013, 2014, 2015. This is an improving and favorable look, and it looks quite a bit better than these periods or looks that we want to avoid. Similar situation when we look at Brazil, EWZ, still looks decent here from a longer term perspective, and even the intermediate term trend looks good on October 14th at 2:23 p.m. From a weekly perspective, ugly. We'd like to avoid this look. This is the type of look that we want to participate in or have an investment with a look like this. It's subject to change, but it hasn't changed yet. Blue on the top with a bullish slope. Blue on the bottom with a bearish slope. Dividend stocks, interest rate sensitive. This sideways movement here speaks to the Fed talking about raising rates. Maybe we won't raise rates. We'll raise them 4 times. We might raise them once. We may raise them again. They have been all over the place with their guidance, and it's been very, very confusing for anything that's interest rate sensitive. As of October 14th, the slope of the 200-day is telling us this looks like a pullback within the context of a rising trend. Obviously, that is subject to change. The weekly chart for SDY also has a nice look relative to the looks we want to avoid. 200-day moving average for materials still has a bullish slope to it on October 14th. And the weekly chart has not given up its full-bore bullish look yet either. Blue on top, blue on the bottom, blue on the bottom. XME, metals and mining, long-term downtrend, trying to turn to a long-term uptrend. This is still a steady and nice-looking slope on October 14th. XME weekly, ugly long-term downtrend. This is a nice-looking turn. This still looks quite a bit better than these high-risk periods we've been looking at. Physical commodities as of October 14th. The present-day look here looks quite a bit better than this higher-risk downtrend here. As we've covered in past videos, commodities have been out of favor for quite some time. Now this weekly chart is trying to turn back up in a bullish manner. This look here is almost the mirror image of these higher risk early stage looks here. It's been a very, very difficult period. Look at the intermediate term trend here in tech stocks. Down, up, flattish and confused, even rolling over 200-day. This is a bearish look here in early 2016. Now the 50's above the 200, and the 200's trying to turn back up on October 14th. Remember, volatility in a 50-day when we have a rising 200-day is not as concerning as a look like this when the 200-day starts to roll over. We don't have that yet. This is a good-looking weekly chart. We have a tight-looking cluster for our moving averages when the market is confused with the assistance of the Fed's all-over-the-place guidance. Now, the present-day look looks like this more favorable period here in late 2014. This much better than this. Transportation stocks have been laggards. The 200-day is trying to turn back up. The 50's recaptured the 200 and has a decent-looking slope here. Similar situation in the weekly. This isn't a great look, but this look here is better than this higher risk look here. Commodity-rich Australia trying to make a bullish turn. The slope of the 200-day on October 14th still looks favorable, and the 50-day looks decent as well. One of the best ways to look at these charts is to think of this. If I were taking a technical analysis test, multiple choice, and they showed me this chart, and the multiple choice answers were, does this look like the beginning of a new uptrend, the beginning of a new downtrend, or C, none of the above? The answer is easy. This looks like the beginning of a new long-term uptrend and doesn't really look anything like the beginning of a long-term downtrend. Similar story with small cap growth, 200-day trying to turn up. The weekly chart has moved from a higher risk look late in 2015, early 2016 to a more favorable look on October 14th. From a long range and strategic planning perspective, it's always prudent to look at an improving look. This looks like the early stages of a new long-term trend. It's always prudent to ask what could go wrong and potentially reverse this trend. The answer is basically central banks and interest rates. We've talked about this before. The quick summary: here the markets look favorable. Here the Fed starts talking about raising rates. Eventually they do raise rates here. The market doesn't like it at all. This looks like the early stages of a new long-term downtrend and the early stages of a new bear market. Then the Fed starts to change its tune from we're going to raise rates 4 times to we're not so sure. Therefore, if the Fed talking about and actually hiking rates caused the market to roll over in 2015, it is possible the Fed talking about raising rates, and if they stay with that script and they actually hike in December of this year, nothing says we can't morph from a look like this to a look like this, which is nothing new under our approach. If that's true, then we will start to see a look like this, and this will start to change. We're not there yet, but this short little story here of what could go wrong helps us keep an open mind about what's going to happen next. All we know right now is this still looks good. In fact, it's improving. Red above green here. Full bore bull is blue, red, then green. Blue, now red, then green. It's extremely important to emphasize when we show these longer-term charts. It really doesn't tell us much of anything about what's going to happen on Monday or next week. The math and the charts help us discern between volatility to ignore and volatility to respect. Here, this looks easy at point A in 1991. This is a full-bore bullish look. The slopes are all up. It looks very, very easy with the benefit of hindsight. However, when we zoom in, there's an incredible amount of volatility here. Therefore, the way the model looks at that is, if the volatility that you have in hand does not look like a high-risk period or the beginning of a new long-term downtrend, then you try, if the math allows, to let your position swing and classify it as volatility to ignore. Regular viewers and clients may be wondering why it seems like we've shifted away from a short-term focus. We have, and there's a reason for that. When the charts look like this in late 2015 or the second half of 2015 and early 2016, this is a higher risk look. This right here and this right here, they both look like the early stages of a new bear market. These are higher risk periods, and therefore we do focus on shorter term outcomes to try to get an idea of how bad this could get or could it rebound. That's not where we are today. This look here in SPY as of the close on October 14th doesn't look anything like this from a long-term risk-reward perspective. It doesn't tell us that we couldn't get some type of dislocation, but even if we did, when your slope is up like this, as it was in 1987 recovered relatively quickly, unlike a bear market that would last years. So even if we get a dislocation or a rapid drop, it's lower risk from a long-term perspective when price slashes through a 200-day with a positive slope. It's higher risk when price slashes through a 200-day with a negative slope. So we have shifted our focus because it's much, much easier to classify short-term movements in here as volatility to ignore than this period in here. It's very, very difficult to classify this as volatility to ignore. If this chart morphs into something like this and this, then our focus will shift back to a shorter term perspective until a clearly defined trend emerges. In this case, it appears that the clearly defined trend has emerged, and for now, it looks bullish. This is the value line geometric index. This is the Brexit low, A to B move. It's gone back to the 38.2% retracement. Looks like a normal retracement at this point. S&P 500 weekly close October 14th. If 2134 does not hold, then the weekly support in terms of the Brexit box really comes in around 2100, a little bit below 2100, and the bottom of the Brexit box is 1991 S&P 500 weekly. Just a quick reminder, it's been a difficult market. NYSE Composite, the broad stock market. This is today. This is October 14th. If I go back over 2 years, the broad stock market is down 6%. So if we bought the broad stock market in July of 2014, buy and hold, we had a ton of volatility. And as of October 14th, or actually earlier this week, this is at this week's low, we were 6% below the July 2014 level. It's even worse if we look at the 2015 high. Earlier this week, we were 7.36% below the peak in 2015. This is a frustrating and difficult, highly volatile period. It's not particularly friendly for our model. The model does make adjustments when we stay in the box for a long period of time. It's next to impossible to figure out that you're going to be in a long-term consolidation box when you're in this rising trend here. It gets easier to understand here. This is weekly stocks versus bonds. This is a very rare look here. This is the ratio in July. Look how confused and flat it is here. This is an illustrative look at the Fed's flip-flopping and mixed message. The market almost looks like it's given up here and just is flatlining now. If you're frustrated out there, you're not alone. Here's another example from Bespoke Investment of the Fed-induced land of confusion. Utilities, which are interest rate sensitive, recently were the most overbought since March of 2016. Then just a few weeks later, it went from the most overbought to the most oversold since November of 2012. This type of look here speaks to massive confusion relative to the message, mixed message, and ever-changing message coming out of the Federal Reserve. The markets are confused. At one point, they think utilities are the place to be because they're not going to raise rates. Soon thereafter, everybody's running for the exits because they've flipped back over to we are going to raise rates from a script perspective. At some point, this will calm down. It has not calmed down yet. Janet Yellen gave a speech on Friday, October 14th. We've highlighted some of the more important passages on these two slides. You can pause the video if you want to read them, but basically, if you know anything about the Fed, it's next to impossible to read her speech as hawkish. It definitely leans on the dovish end of the spectrum from a longer-term perspective. However, the markets are still expecting a rate hike before the end of the year, something that we'll be watching in terms of those odds and something that we have to respect. Even with all the positive slopes in the 200-day moving averages that we've covered, it is quite possible that the S&P 500 could fall further. One example, here's the A to B move, here's the Brexit low, here's the high. Normal and to be expected retracements would take you to 2116, 2092, or 2068. The close on Friday was at 2132. So from a psychological perspective, we should keep an open mind about shorter-term outcomes. They could include a bounce at these levels or more weakness early next week. Should also be noted that all volatility within the context of a rising trend in the early stages is classified as volatility to ignore. So when you start to roll over here in 2000, in the early stages of it, it looks like volatility to ignore, but then it morphs into volatility to respect. Under our system, the key is we don't jump the gun. We assume we're in an uptrend until proven otherwise. The charts that we've shown this week tell us from a long-term perspective, and thinking in probabilities, all of the charts that we've looked at look like a long-term uptrend and a pullback within the context of that long-term uptrend. It doesn't tell us that we can't morph into something like this or something like this. Only time will tell, and that's why we'll head into next week with a flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.